In 2008, the world economy nearly collapsed. Banks failed. Markets crashed. Millions of people lost their jobs and homes. But how did it actually happen? To understand the 2008 crash, we must start with housing. In the early 2000s, housing prices in the United States were rising fast. People believed real estate prices would always go up. Banks were eager to lend money. And almost anyone could get a mortgage. Even people with low income or poor credit. These were called subprime mortgages. Banks gave loans to risky borrowers because they believed housing prices would keep rising. If someone could not pay, the house could be sold for profit. At least, that was the assumption. But here is where things became dangerous. Banks did not just keep these mortgages. They bundled thousands of mortgages together and turned them into financial products. These were called mortgage-backed securities. Investors around the world bought them. They believed these products were safe. Credit rating agencies even labeled many of them as low risk. But many of the mortgages inside these bundles were risky. When housing prices stopped rising in 2006 and 2007, problems began. Some homeowners could not afford their payments, especially those with adjustable rate mortgages. When interest rates increased, monthly payments increased. People started defaulting. Defaults increased. Foreclosures increased. Housing supply increased. And when supply increased, prices fell. Now the assumption that housing always rises was broken. As prices dropped, millions of homes were worth less than the loans attached to them. Banks began losing money. Investors realized the mortgage-backed securities were not safe. Confidence collapsed. Financial institutions that were heavily exposed to these products suffered massive losses. In September 2008, one of the largest investment banks, Lehman Brothers, collapsed. That moment triggered panic across global markets. Banks stopped trusting each other. Lending froze. The financial system depends on trust. When trust disappears, money stops moving. Stock markets crashed. Businesses could not get loans. Companies cut jobs. Unemployment surged. The crisis spread beyond housing and banking. It became a global recession. Governments and central banks had to step in. The Federal Reserve lowered interest rates to near zero. The government launched bailouts to stabilize major banks. Trillions of dollars were injected into the financial system. Slowly, confidence began to return. But recovery took years. Millions lost homes. Retirement savings shrank. Economic growth slowed globally. So what caused the crash? Excessive risk-taking. Overconfidence in housing prices. Complex financial products that few truly understood. Too much debt. The 2008 crisis showed how connected the financial system had become. A housing problem turned into a global crisis. It also changed regulations. Banks faced stricter rules. Capital requirements increased. Risk monitoring improved. But the most important lesson was simple. When easy money meets overconfidence, bubbles form. And when bubbles burst, everyone feels the impact. The 2008 crash was not just about housing. It was about risk without responsibility. It was about believing growth would never stop. History shows that cycles always return. Markets rise. Markets fall. Understanding what happened in 2008 helps us recognize warning signs in the future. Because financial crises do not come from nowhere. They build slowly. And when the system becomes too fragile, one small shock can break everything.